Climate Change Global Innovation Hub to give the welcoming remarks before we start this session. Masamba, you have the floor.
Thank you. Thank you so much, Nitin. And good morning to all of you. Very pleased to have you here. Good morning and welcome to our panelists. My name is Masamba Choi. I'm the project executive of the UN Climate Change Global Innovation Hub, an initiative of the UNFCCC Secretariat launched at COP26 in Glasgow. So now we have 2 years of existence with a one-fold vision, which is how can we mobilize innovation to serve the many people and the planet. It's extremely relevant because while science is value neutral, innovation has always an agenda. And so far it has been used extensively and not enough to serve power, economic power and military power. So what we want to see is to what extent we can contribute in making innovation serve more the many people and the planet. So we have a twofold mission with two elements. First, we want to contribute to the acceleration and the upscale deployment of existing solutions. Now, when we say solution here in the Global Innovation Hub, we do not mean only innovative technology. We mean also innovative policy instrument, innovative financial instrument, innovative business model, innovative cooperative approach, an innovative product from the culture and creative industry. Because what we know is that if you want to deploy at scale, you need to have an integrative approach where all these different innovative solutions are combined to respond to a given demand. The other element of the mission is how can we contribute to the acceleration of the missing solution, because you have the existing one that we need to deploy at scale, and then we have the missing one that we need to develop with existing science, apply science, or with new science that will need to be created. And we have a threefold vision that is articulated around three key principles: caring, sharing, and daring. Caring because if we want to address the climate and sustainability challenge, we need to be genuinely caring for the needs and the well-being of the many people and the planet. Sharing because we need radical collaboration if we want to address the global challenge. Silo will not work. So it means that we need to share knowledge, and it's why we are strongly supporting open science. We need to share experience, and we need to come up with the mindset of solution provider. It's not about solving my own problem only. It's not for countries to focus on their own problem. It's not for cities to focus on their own problem. It's not for corporate to focus on their own problem. What is needed is to be solution-oriented and committed to developing solutions that others can also use. And finally, the daring part. We cannot have innovation if we are not daring. The problem we are facing when it comes to climate and sustainability innovation is that most of the time, we are setting our goal and our target based on our understanding of what is possible. We will look at the solution that exists already, and we set our goal based on that solution. And why are we doing that? Because we want to be credible. If you come up with, as a CEO, for example, if you set very ambitious goal for your organization, your board of directors will ask you, how will you implement? What are the type of action that you want to implement? What are the leverage points that you will use to achieve this goal? And if you say, I do not know, they will say you are not credible. So it means this is why people are setting goal and target based on their understanding of what is possible. But that's not the right way to go. When it comes to climate and sustainability, goals and targets should be set on the basis of what is needed, not what is possible. And it's precisely the gap between what is needed and what is possible that is the main driver for innovation. So this moonshot thinking is central for the development of climate and sustainability solution that will enable the transition to a regenerative world. So thank you again for your time, and looking forward to very productive panel discussion. And with this, I will hand over to the chair.
Hello. Thank you so much, and thank you so much for setting the context so well for us. I love what you said about moonshot targets, because I think if we aim for the moon, we'll get further than we expected. I think that's exactly what we should do. So good afternoon, everyone, and thank you so much for joining us today. We have a very interesting session planned for you on financing transformative climate and sustainability solutions aligned with the 1.5-degree goal and the SDGs. And I'll quickly start by introducing our distinguished panelists. We have with us Sonia Gibbs, who is the Managing Director and Head of Sustainable Finance at the Institute of International Finance, IIF. Thank you so much for being here. We also have with us Oluranti Doherty, who is the Director for Export Development at the African Export-Import Bank. Thank you so much for being here. And we also have with us Domenico Nardelli, who is the Treasurer for the Asian Infrastructure Investment Bank. Thank you for being here, sir. And Mr. Fanglu Wang, who is the Managing Director of CITIC Capital. Thank you so much to all of our panelists for making the time to be here today. And maybe what I'll do is start with a bit of context setting before asking or posing the questions to our panelists. And there's been so much discussion on finance in these last couple of days at the COP. Right? And there's such a diversity of pledges that countries have made, ranging from the loss and damage fund to, say, nature finance hub, to non-CO2 emissions, to Altera, which is a big, the one for mitigation, to even, for example, agriculture and food systems. In fact, the first time a fund launched for capacity building for education, right? So there's been a huge diversity in terms of what countries have been pledging this time. So I think we're moving in a good direction, in the sense that I think this has been the concern for the longest time, that a lot of money is being spent on mitigation and not enough on adaptation and capacity building. So I think we're moving in the right direction. But at the same time, it's very important to acknowledge that there's still a huge gap. If you look at the emissions gap report, in terms of all the pledges that countries have made already, we're on a 2.5 to 2.9 degree sort of pathway, so closer to 3 degrees. So there's a significant gap when it comes to intent versus the effort estimate of where it might get us. So having said that, what has been promised so far is still the first step. It's still a drop in the ocean in terms of what we need. And what we need today is not incremental change. And I think that's what studies and the IPCC reports and any of the emission gap reports have been telling us, is that it's not just incremental changes that will get us there now. It has to be transformative, economy-wide, systemic changes that will eventually now get us there. And having said that, it can't be solved on a sector-to-sector basis. It has to be a whole economy approach that we have to take. And it's not that we're not moving in that direction. I think in several sectors, we've done a lot of, we've made a lot of progress globally, whether it comes to energy supply or, say, transport or buildings for that matter. But having said that, even when you talk about energy supply, I think with renewables, we're still a certain way ahead. Not all the way there, but still a certain way ahead. If you look at the latest IEA reports, which rightly points out that investments in the energy sector have slumped in the recent past, given a variety of reasons, but also economic instability, rising costs. Right? If you look at clean energy specifically as well, while the investment is growing, it's still growing slower at the moment. And I think, again, a lot of different reasons. But this last year, we've had a record sort of pull out in terms of investment from clean investment vehicles by investors. So that's somewhat concerning, but I think that's a global problem. But so with this, my first question to Ms. Gibbs is, clean energy projects need long-term financing, typically plagued by the kind of challenges that most infrastructure projects are, right? So how do we ensure that climate commitments translate into concrete and sustained financing for these transformative climate solutions?
Hello, and thank you for that framing, and thank you for your remarks. Very much appreciated. And I take your point, really. I mean, the gap is massive, and therefore the solutions that need to address the gap are inherently complex. I mean, well, thank you. Haven't even said anything yet. Well, look, the short answer is that we've got to have the right policy, regulatory, and political environment to enable credible transition planning, and that in turn supports transition finance. So one of the central questions at COP is, how do you mobilize and channel private sector capital, kind of turn it into quasi-development finance? And that encompasses a whole range of things. I think it's important to understand what we mean by transition finance. I mean, clearly you have the things that are already very green: climate solutions, a green finance, all the types of things we think of as green. But we also have, given the makeup of our global economy, a tremendous amount of financing that is to companies that are currently brown but need to get to green. And that's the very definition of transition finance. No sector left behind, no matter how challenging. And that's really important to remember in the context of what we're talking about here at COP. Because this type of transition finance is not only high emissions industries, your oil and gas and so on, it's also small and medium-sized enterprises, small businesses, which tend to be less green in their energy requirements. And importantly, it's emerging and developing economies. All of these economies, sort of by definition, tend to be much more reliant on fossil fuel, and in particular coal. So I mean, if you kind of just sort of wave a wand and say all finance shall be green, you know, you're just kind of not paying attention to the reality of what we need to do to get to transition. So I think managed phase-out is the other piece that's really important in transition finance. But this comes with risk, and I think risk is a central element of how finance is priced. So green is obviously the biggest risk of these categories. It's also reputational and litigation risk, so it's a real concern. But it's also the biggest need and the biggest. So there's kind of three challenges for the financial services industry. First of all, we're not in the driver's seat, right? You had mentioned this. Transition needs a whole economy approach. So kind of how fast we get to net zero is going to depend mainly on the effectiveness of government policies. And oh my goodness, could we ever get to a global carbon price? Because that would be the magic wand that would sort of solve all of these things, you know, because everybody would be financing green around where we're effectively penalized, however. But finding global consensus and alignment on financial sector regulation and policy around climate risk and transition planning is very difficult. I mean, I've been working in this area for decades, and it's not easy, you know, as any of you in this industry know, to find consensus on regulation on anything. But this, because climate is such an inherently political sort of topic, is particularly difficult, and you've got big divisions on the approaches to regulation, especially in areas like approaches to the use of the capital framework. Are you going to use, you know, should green assets be subsidized? Should brown assets be penalized? Disclosure, how much should you disclose? You know, does it need to be just the bare, or is it everything under the sun, as you taxonomy? You know, everybody has a different definition of what is green, and even things like consumer protection. So fragmentation is a challenge to scale. And finally, and you know, I think this is a really big question. Financial firms have limited direct influence over the emissions reductions of our clients and the firms that we invest in. A lot of this is simply out of our control, despite the growing momentum in ESG engagement and stewardship. And this goes back to the importance of broader economic policy. At the end of the day, there's a lot of uncertainty about demand for sustainable and transition products and services. And this is an area where governments can make a big difference, for example, policy incentives that can change corporate and consumer behavior, because the financial sector can't drive this change. Enable, support, provide transition finance, but we cannot drive behavioral change. And this speaks to the inherently political nature of climate finance. And think about this. We have 40 elections coming up in 20 regional and national levels. We convene for, are we going to be in a very different environment for climate finance? Are we going to have a continuation of ESG backlash? You saw the elections that took place in the Netherlands and the shift there potentially could happen in Germany as well. So the bottom, we need strong, pro-growth policy frameworks at national and global levels to give us a foundation, a long-term orientation, and market conditions to mobilize private capital. And it has to be done on a pro-growth basis.
Thank you, Sonia. I think you raised a lot of very pertinent points around, and especially on the challenges from the financing side, given that you have very little control on the behavior of the borrower companies that you're financing, essentially. But you also mentioned two other points, one around the fact that there are inherent risks when it comes to a lot of these technologies. And the fact is that you're not just financing big companies, you're also financing smaller companies that have limited access to capital. So I think that's an important point, and that's a good segue into my next question is the fact that we know that the urgency is real, right? But we do require long-term commitments, and a lot of these technologies that companies invest in today, they can provide returns in the long term, but in the near term, it's a risky proposition because you typically, it's not necessarily commercially as attractive in the near term. So my question to you is, Dominica, is how do you balance for a company alignment of these short-term goals with the long-term financing? Because I think it also ties back to banks, which the companies have to essentially pay back to, right? So there's that element of risk, but there's also that element of, the returns come in the longer term. And how do you balance that?
Yeah, thank you. Well, this is a very relevant question, I think. And I also believe that MDBs are part of the answer to this question. Because definitely there is a break in terms of expectation. When you talk about all these projects, particularly for climate finance, in terms of where private sector sits and MDBs, what they can do. You are right in saying that maybe the objectives are not fully aligned, because if you are in the private sector, but we'll talk about this in a second, of course, the return on the investment is an important component of the equation. It cannot be overlooked if you are in a true private sector environment. However, I believe that MDBs and AIB is doing exactly that, can provide part of the answer, because the long-term, the patient capital is there, is with us. There is a reason why MDBs are, some people say, overcapitalized, you can say are abundantly capitalized, but one of the reasons is exactly this. So there has to be someone who is able to mobilize long-term capital and get into the investments that the private sector might struggle to do on their own. So personally, I consider the role of MDBs as, when it comes to private sector investments, the role of MDBs as anchor investments. Those entities that really can come in, can make sure that a project, really suits with the various commitments on the environmental and social standards that we are making, and really be a kind of a lead investor for this type of goals. And I will just give you one example. At AIB, when we work, we have made a commitment to be fully Paris aligned as of 1st of July this year. And it means that when we work with our member countries, we make sure that we want to work with those countries to help them, particularly if they have a national plan towards net zero. And we are going to commit the capital behind that.
Thank you, Dominic. And I think you raised some very important points, especially on access to finances. You'd want to be investing in companies countries that have that kind of framework that's existing to enable, the right absorption of that finance. That's one. But you also talked about the fact that ROI is very important for any lending institution. So it's one is the return on investment, the access to capital, but the other is the cost of capital. And I think that's another big issue for a lot of developing countries. I think because the potential for decarbonization is at such odds with the cost of capital, I think, across countries. And this is what I'd want to come to you, Orante, is that while we understand that most of these investments are very capital intensive, right? And like I said, the high interest rates are a big issue for a lot of these developing countries. What kind of mechanisms can help enable us to mitigate this challenge? And how can we perhaps even look at, and you talked about multilateral development banks and that kind of finance, but also philanthropic finance, perhaps even looking at the CSR of, say, private sector companies. How do we bring all of that together and try and scale this issue?
Thank you very much. When I got the topic of this panel, I was quite intrigued because of the combination of climate and tying it to the achievement of sustainable development goals. I happen to come from the African continent, and most times we believe that these things almost seem to be at variance with each other. But in actual fact, they are not. They actually feed into each other. Achieving sustainable development goals means that you are working towards a climate-friendly environment and an environment where we all can protect the earth. But one thing that has been quite clear is the funding we need to transition. And I'm glad that you used the word, Sonia, transition so many times. The funding we need to transition is about, for developing countries, about $3 to $5 trillion. We know that funding available in the developed world and of course globally is about 300 million. So we are talking of 1% of the globally available funds globally that we need to transition, that we need to support developing economies, but these funds are not there. Then the fact comes up, well, okay, yes, the funds are not there because private sector or philanthropy money is not attracted to developing countries in Africa. We need to do more to attract this. I think that is where we MDBs come in. We need to assist in de-risking some of these projects. We need to work with our member countries. And what I would be pushing for is more of collaboration and partnership between international MDBs and local DFIs on the continent. We need to work together more to be able to de-risk green projects, renewable projects, climate-friendly projects, adaptation projects, in order to attract philanthropy money, private sector money, and some of the things we need to work on, including coming up with climate-friendly solutions like pricing carbon appropriately. We know that right now, like you mentioned, the use of carbon rather than reducing is increasing. So why don't we price carbon appropriately? Why don't we issue carbon taxes so that if you use it, you pay for it, and then the funding from there goes to support green projects in vulnerable countries in Africa, in the Caribbean, in Asia, that feel the impact of climate change through things like drought and flood. Another thing we need to do is to ensure that we support the creation of appropriate policies and incentives. If you are going to move people away from investing in fossil fuel projects, then you need to incentivize them. And how do you do this? You need to be able to, come up with policies that, support, price stability, which facilitates investment in climate-smart technologies. You need to also focus on carbon emissions and how do we get equitable carbon pricing across the world. Today, Africa has not been able to plug into harnessing its enormous green resources, forests, resources that should generate enough carbon credits for it, because there is no equitable carbon pricing for carbon generated in Africa vis-a-vis in the developed world. Also, there's need to focus on targeted incentives to companies, to project developers that will promote the development of low carbon investments in each country. And we must bear in mind the country's specific needs, because it's not going to be a one-size-fits-all or a one-solution-fits-all. African countries have been saying for a while now that, look, you need to kind of understand what we need. We know that we need to transition. The whole world knows that you need to move into green energy, renewable energy, but Africans must be able to move on a gradual pace that does not compromise industrialization. So we need to also be able to work with local DFIs on the continent to be able to de-risk some of these projects. They can do this using guarantees. A lot of African DFIs like myself or like Afreximbank, we have developed quite a lot of guarantee products, country risk guarantee, investment risk guarantees, etc., to attract philanthropy funding and private sector funding into the continent. But we need to be able to partner with international MDBs to be able to attract this funding, because this funding resides mainly and predominantly in the developed world. We also came up with a concessional finance facility, which we will also be seeking partnership on, because a lot of these projects, like you said, they need patient capital and they need philanthropic capital. They also need us to be able to match that philanthropic capital that will come into Africa. So the only people who can match it will not be governments, because as you know, African governments are very burdened now. They are operating in tight fiscal space. They have increased social spending, and they have huge drop in their revenues, and they are also burdened by increased debt repayments. So using local DFIs, I think, is the key and is the way. And supporting local DFIs to be able to de-risk these investments onto the continent is also something that we need to work with, leveraging their guarantee programs, their concessional financing, their project preparation facilities, etc. Thank you.
Thank you so much. I think, thank you for raising all of the challenges for the African continent so well. I think it applies to a lot of the developing country context. But one thing I heard both of you, Sonia, and you say is talk about pricing carbon, and whether the price of that carbon is really right, given does it incentivize green enough and disincentivize brown enough? I think that's the right question. And with most of the kind of mechanisms, and right now, I would say almost half of the world is governed by some kind of a pricing mechanism, whether it's direct taxation or it's through the carbon markets. But at the same time, is the pricing evolving to be able to reflect the right price that we need to steer the economy? I think that's important. And a lot of our, in fact, our modeling forecasting studies also show that unless you tax the carbon, unless you tax the carbon or tax the private sector for the emissions, if you expect the public exchequer to pay for the decarbonization in the long term, that has a huge impact on our developmental indicators, such as when you talk about jobs or you talk about equality and income equality. So all of that is there. So, my question is to Mr. Wang, is, speaking about development, or if you want to just quickly reflect on this point? Yeah, sure.
Do you?
Oh, okay. Okay. Right, so if you'd want to reflect on the carbon pricing quickly, then I can move to the development side. Yeah, sure.
I would just think about carbon pricing. There's very little that any of us can do to resolve the giant dilemma of the lack of a global carbon price, right? I mean, Europe's going to do what Europe's going to do. The US is not going to go there. Face it, carbon pricing is politically unpopular, so we're never going to get to an ideal solution there. One thing I would highlight is the potential, though, of voluntary carbon markets. I know that there's a lot of stigma around them, a lot of legacy problems, a lot of concern about the quality of carbon offsets. But I sit on the board of the Integrity Council for the Voluntary Carbon Market, and one of the things we've done is come out with this kind of yardstick for what is a good carbon credit, what is a good carbon offset. So on the supply side, I think we've added to the toolkit there, and there's a lot of progress being made. We do need to resolve this question of how do companies credibly use them? Is it okay to use, X percent of your emissions reduction as credits from carbon offsets? So, but once we get that, and to our point about debt, right? Because a lot of emerging economies are highly indebted. If they can sustainably monetize their natural resources in a way that they can generate these carbon offsets and sell the damn things, I think there's a lot of potential benefit there.
You're right about that. I'm so sorry, Mr. Wang. Just to speak to that, at Flexing Bank, we've been working with the Economic Commission for Africa, and we've been trying to work on developing carbon taxonomy for the continent, also to develop carbon registry, carbon markets initiative, because what you've said is something that has played on actively with our member countries. At the Africa Climate Summit in Nairobi in September, President Ruto issued a call for there to be appropriate pricing of carbon for the continent, and also in the evaluation of countries' GDP, for you to be able to consider the carbon resources, the biodiversity resources of these countries in assessing their GDP. And that this is a fair way to go, because, of course, it gives these countries opportunities to harness or monetize their huge resources. There are huge biodiversity resources that serves as the lungs of the world.
Absolutely, and I think the voluntary markets have got a bad rep for a variety of reasons, but it's an economically sound concept, really, and does lead to development, and even at the grassroots level, for that matter. If you look at the larger kind of projects that are dominating today are the nature-based solution kind of projects like forestry, agriculture, and that is reaching the lowest common denominator when it comes to the farm level, the farmer themselves. So I think there's a huge development impact related to this. So just maybe talking about development and moving beyond just mitigation or climate. A lot of banks are now reporting on their alignment with the SDG goals as well, which goes far beyond just climate. But for climate, we have a lot of existing frameworks. But for a lot of these other SDG goals, we perhaps don't have such comprehensive frameworks. But there's, for example, with biodiversity, we are seeing new frameworks emerge for the financial sector. So my broader question is, how do financial institutions align their strategies with 1.5 degrees, but also ensure that they're contributing more broadly to the SDG goals?
Thanks. I learned a lot just from the comments my fellow panelists have just kindly shared. From my perspective, being based in Asia Pacific, focusing on climate-related technology investments since 2010. So I think we have longer experience and track record than most of our peers. So I think we have the benefit of the hindsight for us to understand the future a little bit better. Yes, 13 years ago, 2010, when we started this investment strategy, actually we didn't know too much what to do. But then finally, I think our thought process has been focused on finding the common denominator for all the economies, rich and poor, south or east, or north or south, or east or west, right? It was based on a very simple idea. That is, the common denominator, if we can find, should give us the best margin for error, which is fundamentally important for private sector investment manager like us. And every technology has its merits, but it also has its limitations, especially on the cost, right? So we have beaten this topic so much. So then we have been very much focused on technologies and the products that can be broadly applied across different markets. We're never happy with any technology products that can only work in one market, no matter how big that market is. You can say it's a US market, China, India, whatever, right? Or Europe, right? But then any technology that can only work in one market, I think inherently carries certain types of risks that we need to be careful about. So that's why, first of all, we raise the bar very high for ourselves on finding the technologies that can be applied across different markets. So that is probably a very important test for the technology merits and also the sectors you just mentioned, right? So we actually broadened our scope over time. Again, we started from a very simple idea. We just kept thinking, what is needed by every country, anywhere in the world, right? So a country, no matter where it is, needs to provide its people with clean air, clean water, efficient transportation system, and logistics and other infrastructure systems. So this is exactly the path we took. So we started with, of course, now it's called clean energy efficiency technologies. So we've built a lot of experience in it. But then over time, we also started to look at technologies that can benefit food and water use, and also decarbonization of the supply chain, including but not limited to transportation, logistics, and various types of production processes. So it is a kind of a long evolution, but then the common theme, the basic principle is to make sure that the technology itself has enough inherent value to be built. Because as an investment manager, we manage capital from different sources, which share the common goal, but also carry their own limitations. So, for example, like MDBs. We work a lot with MDBs, IFC, EBRD, AIB, Asia Development Bank, right? So they are definitely more patient than most of the others, but they also have their geographic mandate. So they can only take exposure in certain countries, right? But then chances are the technologies we find can be applied not only to these countries, but also to other countries, and both rich countries and poor countries. So this has become sort of a high quality problem for us, right? But then let's say if we go to the other extreme of the private capital, then yes, we have private capital sources that want to do something with climate change, but then they have their own requirement on the investment horizon, liquidity, whatever. Then that actually have screened out a lot of opportunities. So then our experience has been that the journey is difficult, because we, as the custodian of the capital, and we have to achieve our goal, but I also listen to the various investors for what they need, right? So I am encouraged that more and more investors have come to reconcile the need, the return for the capital and the liquidity with the long-term goal of climate change. But then it is a far unsatisfactory situation for us. But then the progress has been significant. But then I just want to have the chance to present our experience and prove to as many investors as possible that it is possible to find technology and the products that work across different markets and create value by themselves, rather than overly dependent on government subsidies or various types of incentives.
Yeah. Thank you so much for sharing your perspectives. I think I hear that the choice of technology for you is key, and the scalability of it. Now, when it comes to scalability, I think one big lever is also collaborations and partnerships. And just coming to you, Sonia, I know the one big announcement at COP26 was the GFANZ, right, which is a Glasgow Financial Alliance for Net Zero. That came into spotlight as a global coalition of major investors, leading financial institutions that committed to accelerating the decarbonization. So I know you've been a very integral part of that entire process. So what has your experience been like so far, and in terms of enabling financial institutions to contribute to the net zero transition?
I mean, one thing to note about GFANZ is that big dreams come with big risk, right? I mean, GFANZ took on the world, I mean, literally. I mean, they want to do everything from transition planning frameworks and toolkits to mobilizing capital. You have these just energy transition partnerships, and you have a very big work stream on transition planning, which is an integral part of every financial firm's future. So they're seeking to kind of build a bridge between the long-standing framework that the United Nations had. There's a United Nations Environmental Program, and there's all of the NGO community efforts like science-based targets and so on, bridging that, and then where the regulators are going, the financial regulators in a world where there never was financial regulation before. So a lot was taken on, a lot of constituent parts, the Net Zero Banking Alliance, the Net Zero Insurance Alliance, and so on. And I'd say there have been some really phenomenal and impressive successes, but there have also been a lot of challenges. So let me talk about the challenges first and then go to the successes. The challenges, I think, are two. It's like herding cats, getting the financial sector to move in a single direction or come to consensus on just about anything is very difficult. And transition planning in particular is no different, right? Because in many ways, when you think about what is a transition plan, it's a little bit like a long-term business strategy, right? And so for financial firms to sort of offer up their business strategies for evaluation, by regulators or by the world to be judged, there's no good yardstick. What does it mean to have a creditable transition plan? It's going to vary from firm to firm. So it's really challenging to build consensus around what is a good transition plan. And the financial services industry is very concerned that premature efforts to sort of regulate transition planning, which, by the way, are not going to fly in some parts of the world. For example, the United States, again, is something that the light touch regulation culture of the US is just not going to pick that up very easily. But if you start kind of using the regulatory system to try to channel finance, you run into some very thorny issues about what is the mandate of regulators and central banks. Their mandate is to oversee financial stability risks, climate risks, and so on, and it goes back to trying to get the regulators to do the job that governments aren't willing to do. And so that's a big problem for GFENS. The other problem is reach, right? The financial services industry is huge. And if you have 500, 600 members, you're going to struggle to build consensus. Also, to be perfectly fair, GFAN's representation in emerging and developing economies is far less. And obviously, that makes perfect sense because these financial firms in emerging economies are a lot further along on their transition journeys. So it's a lot harder to reach. So those are some of the challenges. The mobilizing capital challenge, JETPs are an enormous undertaking and hugely complex. And you have kind of the inherent problems of investing in economies that are still developing their institutions and legal and regulatory structures. So to enable this kind of investment at scale, it's a big challenge. So, all credit for all of the effort there. On the successes, I think I have never seen the attention of this industry, the financial services industry, so concentrated in one place. So to have just built this enterprise, even with the challenges, even with the problems with the insurance alliance, it's still been a monumental achievement.
Thank you so much, Sonia. I think the GFANS is really a great example of, I know it's fraught with challenges given how complex this world is and how big the financial sector themselves are. But the fact is that it's a great model for collaboration. But when we talk about partnerships, collaborations, and other, I think in this entire ecosystem, multilateral development banks also have a very important role to play. I've been following the conversations in the stock take for the last couple of days, and the debt situation of the countries, that's coming up again and again. The fact that finance needs to be more concessional than it is coming up again and again, right? So I feel that MDBs have a very important role to play, and in this last year, it was a record high in terms of investments in climate when it comes to MDBs. But at the same time, we know that it needs to be even faster, deployment, in terms of the pace and scale that science demands, right? So where do you see, what do you see as some of the major challenges, and how can we accelerate this deployment for clean infrastructure? And I know that you have to leave soon, so I'm going to try and close it after this thing.
Yes, thank you, and I apologize in advance if I may have to go to another panel. But you are raising a big issue here. Concessional finance is a huge part of the solution to the problem, and something that not all parties always agree on in terms of how to tackle it. I give you the example of my own development bank, the bank that I work in, AIIB. AIIB was founded with a large capital endowment, but it was founded from the beginning without a soft window arm. So it's a little bit unlike many other MDBs. So we don't have a pure concessional window as AIIB. However, we know, and everybody in the room knows, that much of the need for this type of investments resides in low-income countries. So what we are doing is, we have tried to tackle this with kind of extra resources that are brought on from additional donor financing to soften up a little bit our loans into some of the countries that are in need. Is that enough? Personally, I don't think so, because of course you need large amounts of money to top up the capital, and softening up a little bit a loan, particularly in the context of the rate cycle and the massive reversal in rates that we have been going through, is not going to be enough. I think philanthropic money can be part of the equation, because we know that there is massive pool of capital in there that could be used to this effect. So that's certainly a part of the solution. We are also, particularly at AIIB, we're also trying this avenue. We're trying to generate more involvement from philanthropic money, and we are deepening our ties with many of these funds globally. So that's another one. Another avenue which doesn't really address the issue directly, but can help. I think Oloranti referred to that. We're also trying to experiment with new products, guarantees and other instruments where we can, let the bank get involved in some of these projects that may need a different sort of financing. For example, we are also doing equity investments, direct injection of capital, where we take direct either, debt exposure or equity exposure into some of these projects. So again, I don't have a real good answer to give you, but I do acknowledge that this is a huge part of the problem. The last thing I will say, and this is another from direct experience that we are seeing, when you look at the landscape for climate investments in particular, and at AIIB we do many of those. Climate financing is basically half of all the projects that we look at the bank. And this is our strategy. That's what we want to do. However, only a small proportion of these projects is going to low-income countries. So let's say IDA eligible countries. So, I mean, the reason is very simple, because, if you look at lower middle income and middle income countries, is easier to find bankable projects, of course, in climate finance. So we are seeing that firsthand from that regard.
Thank you so much, Domenico. I think, I hear a lot of very relevant points you raised, but the fact that more finance has to go to these middle-income countries, low-income countries, and the fact that all of these, institutions, whether it's multilateral development banks or private sector or philanthropic money, all of it has to be part of that equation when it comes to the ecosystem that can help solve this issue. So having said that, I think we've run out of time now. But thank you all, to all of the panelists. I learned a lot from this discussion, and thank you all for being here. Thank you.
Thank you, Apurva. Okay, may I request you to please